I just want to start by asking you, you've been a world-renowned economist, you are a professor of economy. So, what is the most essential character of an economist in your opinion?
This is a long story, but let me make it short. I think the narrow skills that are required as kind of necessary but not sufficient conditions to be good are that you really have to have a thorough understanding of basic economic principles, one, and two, a good grounding in economic history, and three, a good command of math and statistics. So those are kind of the narrow things. Now, broadening it out to the really important things is that I think most economists that are good have experience in the markets. They've actually been involved with a business, or they've been trading and know how markets work. In short, they have to have a connection to the real world. Most modern economists do not have that characteristic, and that's why most of them aren't very good. Now, the next item is something called tacit knowledge, and that's something that was developed by Michael Polanyi. And tacit knowledge is a kind of knowledge that you don't really get out of books. It's different than formal codified knowledge. It's kind of intuition, or what we call in the United States street smarts. You just have an intuition about how things are working and so forth. Then the next thing that's related really to tacit knowledge is that you have to be a little bit of a Sherlock Holmes. You've got to know where the rocks are and where to turn them over, how to turn them over. And I think in general, to be creative in any endeavor, whether it's economics or any other field, it really takes a combination of three things. You've got to be excited about the topic, whatever it is. And you've got to be able to work hard and be very disciplined. So most modern people, especially the younger generation, they don't understand it requires hard work and discipline. So those are the main things. And to summarize, I'd say Friedrich von Hayek, Nobel laureate in economics, received a Nobel in 1974, a good friend of Mrs. Hanke and myself, always used to like to say, to be a good economist, you've got to be more than an economist.
Right.
So that kind of summarizes the picture.
Right, Mr. Hanke. Now, if you have to put your Sherlock Holmes cap, and if we talk about, the current scenario, now the central banks of most economies are kept on increasing the rates. So what is the peak? How long do you think this rate hike is going to continue? And even if, the inflation is high, is it a reasonable option to hike interest rates during recession is looming? So what's your point of view on this?
Well, I think number one, let's talk about the United States for a minute, because the U.S. is the imperial power in the world now, and the U.S. dollar is the international currency. So let's talk about the United States for a minute. Let me take you back to 2020 and the February of 2020, to be precise. And at that time, the pandemic started, and the Federal Reserve started monetizing the deficit, the huge deficit that was being created in the United States. The fiscal deficit expanded because we essentially locked the economy down to a large extent, and the federal government started expanding expenditures rapidly, and the deficit expanded rapidly, and about 90% or over 90% of that deficit was actually monetized by the Fed. The central bank bought the bonds that were being issued to finance the deficit, and that increased the money supply. And if you go back to 2020, in May, the 3-month annualized growth of the money supply measured by M2 was going up a little over 77% per year. So that's unprecedented. Never has happened since World War II. Now, what that means, to put it into context, if the Fed was trying to hit its inflation target of 2% inflation, they should be increasing the money supply by about 5 to 6% per year. So it was going at an annualized 77% rate. So as a result, we got a lot of inflation. Something, by the way, my colleague John Greenwood and I anticipated and predicted back in early 2021. We said that inflation at the end of 2021 would be between 6 and 9%. It actually ended the year at a little over 7%, and then peaked out in June of 2022 at 9.1%. So we hit the bullseye. And we hit the bullseye because we're looking at the money supply. We're using the quantity theory of money to analyze what is going to happen. And after about 12 to 24 months following a big increase in the money supply, you get a big increase in inflation. So that was what happened originally. Now we're getting to your question about whether they're going to increase interest rates more. What they've done the last 9 months, actually, the annualized growth rate in the money supply has gone negative. That's unprecedented. And it's declined by an annualized rate of 3.1%. It's never happened. Well, it did in 1929. It happened. We had a Great Depression then, but in the post-war era, this kind of thing has never happened. So to characterize the thing, they put the accelerator to the floorboard in 2020, 2021. That gave us inflation, and now they've put the car in reverse, and the money supply is contracting. Now, what will they do going forward? That's your question. And I think they are not paying any attention to the money supply, by the way. That's why they accelerated and didn't pay any attention to it. And then threw the car in reverse, didn't pay any attention to the money supply. What are they looking at? Now they're looking at the labor market. And they are still enamored with a discredited theory called the Phillips curve analysis. And the Phillips curve says that there's an inverse relationship between unemployment and inflation. So if unemployment goes down, inflation goes up. If unemployment goes up, inflation goes down. That's the model they're using. And as I say, it's discredited, it doesn't work. But what does that mean that they will continue to do? They'll continue to tighten. They'll continue to tighten because the labor market is very strong. Unemployment's very low in the United States. We just last week got some very positive news about employment and the labor market. It's running very tight. So they're not looking at the right thing. It's like flying an airplane and having the wrong measurements on the altimeter. And what's going to happen? What's going to happen is that we're going to have a crash. We're going to have a recession in 2023 because, as I say, for the last 9 months, the money supply has actually been contracting at, again, a minus 3.1% annual rate. And usually you have economic activity changing or slowing down about 6 to 18 months after the money supply has started to decline and contract. So that's what I think is going to happen in the United States, and most countries, by the way, follow whatever the United States is doing. So the Bank of England is talking exactly the same way, and the European Central Bank is talking exactly the same way. Fortunately, I don't think the Reserve Bank is following orders from Washington, D.C. quite as carefully as they are in London and in Frankfurt.
Right. Mr. Hanke, so since you touched upon the Reserve Bank, I just wanted your view on the Indian economy. I'm sure you've been reading about it, like recently the World Bank and IMF also had some positive reactions about the Indian economy. How do you evaluate the state of Indian economy?
I think the main message, if you look at this COVID period, for example, India has been, I would characterize it as surprisingly resilient. And the Reserve Bank has done a pretty good job. You know, I never give these central banks a very high grade, but I would say in this case, part of the resiliency and stability has been the Reserve Bank has been okay. Right. Not great, but it's okay. And you know, they haven't made, let's put it this way, the Reserve Bank hasn't made any catastrophic mistakes. The US Federal Reserve has made catastrophic mistakes. The Bank of England has made catastrophic mistakes. The European Central Bank has made catastrophic mistakes. The Reserve Bank of India has not.
Right.
So that's kind of the short run picture. The long run picture, my biggest concern, and I think one of the biggest problems in India is really the legal system and the rule of law. And until that is improved, I think it will remain one of the biggest drags on India, the legal system. In India, if you're in business and even if you're trading, you don't want to be caught in any kind of legal dispute in India. It's a nightmare, a complete nightmare. And I've talked to many large businesses that have been involved and for one reason or another have gotten tangled up in some kind of legal dispute in India, and it's absolutely just a nightmare.
Mr. Hanke, what's your view on dollarization? Obviously, before the recession, if we can go about, is it a good economic stability for struggling economies? If you can just sum up some of the advantages and disadvantages of dollarization.
If you look at emerging market countries, and I haven't updated this recently, but a few years back, I looked at the performance of central banks in emerging market countries. And at that time, there were about 100 that performed so badly, that their central banks, that I took a position that the central bank should be mothballed and put in a museum in those countries, about 100, at least 100 of them, maybe even more now. And so what do you do if you get rid of the central bank? Well, you have two options. One option is, you mentioned dollarization. I've been involved as an advisor and architect of two dollarization plans. One in Montenegro in 1999. I was a state counselor and advisor to President Djukanovic. And what we did, Montenegro is part of the rump Yugoslavia at that time, and the currency circulating was the Yugoslav dinar. Well, it was a hyperinflating currency. It was a terrible currency. And so we made the German mark legal tender. And of course, immediately the German mark drove out the bad money, the Yugoslav dinar. And so we, as I say, dollarized. It was, I'm using that in a generic sense.
Right.
A foreign currency replaced the local currency. That's what dollarization means. So that worked very well. Then the next time I had an opportunity to do that, I was advisor to the finance minister in Ecuador, and the sucre was a local currency. It had depreciated tremendously, big inflation, huge instability, and we replaced the sucre in 2001 with the dollar, and that's worked very well. The third one that's recent is El Salvador, and that was 2001 actually. They replaced their local currency with the U.S. dollar, and actually they've had the lowest inflation rate of any Latin American country since then. So what you do, you get rid of a bad currency and replace it with a good currency. And a lot of people say, well, you lose the ability to fine tune the economy and adjust things. But the problem is the fine tuning is done so poorly, it destabilizes these countries and makes a mess out of things. Now, so dollarization is one thing. The other approach is something that I've actually recommended that they do in Sri Lanka. Your neighbor, as you know, is in a complete economic meltdown and currency crisis. The rupee is junk, basically. And what they should do is what I've done in Estonia in 92, Lithuania in 94, Bulgaria in 97, and Bosnia-Herzegovina in 97, and that is put in what we call a currency board system. And a currency board system is one in which you do have a local currency. You don't get rid of your local currency, but it's issued by a currency board, and it trades at a fixed exchange rate with an anchor currency, and the anchor currency reserves are required to be 100% of the value of the domestic currency. So the domestic currency is basically a clone of whatever the anchor is. So I think they should do that in Sri Lanka. By the way, Ceylon, before they changed the name, of course, Ceylon had a currency board for a very long period of time, from I think the 1850s. I can't remember the exact date. I think it was 1858. Until 1950, they had a currency board, and the actual reserve currency, interestingly enough, was the Indian rupee. Yeah. But the system worked perfectly well. So the Ceylon rupee was a clone of the Indian rupee at that time. So these currency boards work very well. There have been 70 of them historically, and they have never had a failure, no failures. And what happened, now there are 15. Hong Kong is the most well-known one, the biggest one, is a currency board. The Hong Kong dollar trades at 7.8 Hong Kong for $1 US. So the Hong Kong dollar is as good as the US dollar. It's the same thing. And the monetary policy in Hong Kong then, it's the US. And you ask about interest rates. Well, the interest rates in Hong Kong, they shadow whatever the interest rates are in the United States. And for developing countries, that's good. You want to get rid of a bad institution that creates instability and put in something that stabilizes things and gives you good money. And by the way, both dollarization and the currency board system have a feature that most people don't appreciate. It really puts the politicians in a straitjacket, because you don't have a central bank that can extend credit to the fiscal authorities or the government. And so the government's forced to come pretty close to balancing their budget. In Bulgaria, for example, we put in a currency board in 1997, to kill the hyperinflation, which was running about 242% per month, the inflation. We put it in. After 1 year, the interest rate had gone down in the money market to 2.4%, if you can believe it. The inflation got crushed immediately. Foreign exchange reserves doubled in a year. And now, what do they have? They have the second lowest debt to GDP ratio of any member of the EU in Bulgaria. So, and they've had all kinds of governments. They've had socialist governments, center governments, right governments, you name it. They all balance the budget because they can't go to the Bulgarian National Bank and get credit. So that in a nutshell, we need fewer central banks in these emerging market countries. If Sri Lanka would have had a currency board, they would have never had a currency crisis. They would never have this economic catastrophe that they're facing right now. And they would not have this huge debt problem that they have now. You see, the big thing they're doing now is, how are we going to negotiate the debt, and how are we going to get a haircut and a reduction in the size of the debt so we can survive?
Mr. Hanke, talking about currencies, what's your view on the future of currencies when we are talking about centralized or decentralized, or do you think both financial systems can coexist?
Yes, I think they can, and when you say coexist, right now we have a kind of an international competitive currency regime. We have all these central banks producing money, and okay, there's an exchange rate between the Indian rupee and the US dollar. It trades, so they compete with each other. So if you don't like your rupee, you exchange it for a dollar, or vice versa. I don't think many people are exchanging US dollars for rupees unless they're doing business in India, but the Indian rupee really isn't an international currency, as you know. But to do anything internationally, Indians have to exchange their rupees for dollars, or usually dollars, but also, they're using obviously other currencies too, but mainly the dollar.
I remember in a tweet in 2020, you had said that Bitcoin is a speculative asset. So what is the thing about Bitcoin that Steve Hanke doesn't like? Would you like to elaborate on that?
Well, it's not based on anything. I mean, there's nothing backing it up. You can't redeem it for anything automatically. And I think cryptocurrencies, to be successful, have to be organized like a currency board system. In other words, you can issue a crypto, but the crypto would have to be backed 100% by let's say the US dollar. Everybody wants dollars, let's face it. So the ideal one would be a crypto. You would issue a crypto, and it would be backed 100% with US dollars, and it would trade not at a floating exchange rate, but at a fixed exchange rate. So you could, if you had one crypto, it would equal $1, and you knew the crypto would be as good as the US dollar, because 100% reserves would be behind it, and they'd be audited and so forth. Now, some of these stable coins claim they're backed by something, but we can't even see the books. We don't know what the accounts are, and one after another is crashing, by the way. I think in general terms, with few exceptions, most of these are just Ponzi schemes and scams, and most of them will collapse. And when you say speculative asset, it's like going to a casino. If you want to I don't have any problem. If you want to speculate in these, fine. you should be free to do so. But you should know these aren't currencies. These are speculative assets. So it's like going to the roulette wheel. If you want to go spin the wheel and take a chance, fine. I don't care. But you should know what you're doing before you go into the casino.
Mr. Hanke, one last question. What does Steve Hanke do during his free time?
Number one, I don't have much free time. I'm kind of an old school guy, and I basically work 7 days a week. Now, free time. So my mornings, I work at my study at my home, which happens to be, by the way, about a 15-minute walk from my office at Johns Hopkins University. In the afternoon, I go into the office and meet with my research assistants. I've got about 30 research assistants, so I have to keep them organized. It's like, you know, trying to round up a lot of wild horses. You got to keep them together and keep them moving, or you got a problem. So I do that in the afternoon, and also meet with students, teach classes. As far as free time goes, Mrs. Hanke and I reside part-time in Paris, and that's more free time because so that's it. And I spend quite a bit of time talking about things with Mrs. Hanke, so I wouldn't call it, it's quite pleasurable, and it's kind of free time, but it's serious.
On that note, Mr. Hanke, I would like to thank you for taking time out of your really busy schedule and having a conversation with ET Insights. It was a real pleasure talking to you.
Thank you very much. Good to be with you.
Thank you.